Hey everybody, this is Jose Blasco. We are about to get started in a minute. This is the perfect time to do a sound check. Please go ahead and type a quick hello in the chat box. Not only that's nice, that also tells me that you hear me. And I know always good for us to get started when it comes to sound and video stream and everything else, which I believe it is, but always good to have a confirmation. So please go ahead and do that. Thank you so much. 35 seconds to go, everybody. Hey Joe, how are you? Good to see you. Thanks for that. I always forget at the beginning to turn on the video stream. Here we go. How are you, my friends? Good to see you from here, from the bottom right side of the screen, as always. And we got 16 seconds to go, so almost there, almost ready to begin. Very good. 10 seconds to go. Almost there. Almost hitting the top of the hour, so we are ready to go. That's it. Time to get started. Christian, how are you? How are you, everyone? This is Jose Blasco. This is December 9, 2021. This is Options with Options. We are ready to explore the markets, looking for options opportunities, apply our technologies, enjoy it, learn a lot in the meantime, have fun as well, and exploit what the market has to offer. So you guys make sure that you are interactive during the session. If you have questions, just don't stay there isolated on your end. Just speak up and share what your thoughts and concerns may be. And indeed, I'm here to help you guys. So let's focus and take advantage of this 1 hour of time that we have to spend together. Before we get started, disclaimer on the upper left side of the screen. Please read it carefully. This is important information. Read it completely, as I always say, because it is indeed important. I just said it, right? So counting on you to do that. And as the disclaimer is now fully highlighted, I would like now to highlight the agenda, which is to look at the market, look at our current trades, and then look at new trading opportunities. Okay, so that's the plan. So let's begin. Okay, I'm gonna close the introduction slide before we jump on top and we start looking at the charts. Reminder, tradewithufos.com/Jose. That's the link where you wanna come in order for you to post questions that you may have. You may be watching this recorded, or after these live sessions you are doing some practice, you have questions. You come in here, you log in, then you click on the green button to ask a question, you post it in here, and then we will provide an answer. Not only we, anyone actually can collaborate as an open forum, and you guys can share answers or opinions or experiences as well on top of prior questions, and keep enriching this collection of extremely valuable questions that are being posted through time by our technology users and members in our community. So do that for sure. No need to say that if you have questions, you can just ask now using the chat box, as well as if it was to be something a bit more in the personal side and you want to send an email, nothing wrong with that either. Okay, but I would say this is the perfect forum, because on top of that, it not only helps you, but it also helps the community, just like you can be helped yourself by searching questions and getting answers that are already there waiting for you. Okay, cool. So with all of this said, time to jump in the platform and begin our market analysis. Okay, so where are we at? Well, S&P daily time from here on the left. This is the SPY, the S&P ETF. We can see how today is our day 2 in an up climate. So 2 out of what statistics suggest is 6 is a normal thing to happen. How are you, Ahmed? Good to see you. And therefore we are, just in that process. Okay, now just like yesterday, notice note of caution: the implied volatility for the puts is above the implied volatility of the calls. Okay, this is a 3-day average. Okay, but the distance between is actually quite significant. Okay, so there must be some bearish sentiment from behind the scenes. If we look at the volume map, we have more calls traded than puts. Okay, 1.6 times, 1.8, 1.7, 2.7. So more calls are being traded than puts. Okay, but when looking at the implied volatility today, we can see implied volatility for the puts is 16, where the implied volatility for the calls is 14. That if we look at it today, if we look at the 3-day average, we also see the same thing, meaning that not only as an average, there's been more put buying than call buying, or there's been more call selling than put selling, or both, more put buying and more call selling at the same time. So not only that has been happening recently, but it seems that today too. Okay, so the fact that we have more calls being traded does not necessarily represent anything that bullish at all. Okay, so we need to be careful with that to not to get in trouble, because indeed the climate is blue, but just like we commented yesterday, on top of that there is no green UFO anywhere close. And if the market falls, which is probably the reason why so many puts are being bought, if the market falls, there is plenty of room to at least reach 459. So we gotta be prudent and careful, even though being in an up climate, I would not be surprised that maybe at the end of the session, maybe tomorrow, maybe Monday, some on-field orders are added and we start seeing green UFOs. That I would not be surprised either. But until that happens, it's too much of a guess or a gamble to rely on that, because it hasn't happened yet. Okay, so let's rely on evidence, because that produces more probability and more stable outcomes in our trading. Okay, Mario, good to see you. Mark, good to see you as well. It's nice to have you guys in the room. Very nice. And with that, the last point of my market analysis here will be the VIX, which I'm sure you are all expecting. The VIX has been going lower. The VIX pointing at 20 today. It's been moving lower, isn't it? And the reason why the VIX has been moving lower is because again, while the S&P has been dropping, okay, which normally we tend we push the VIX to the upside. So it doesn't seem that it's creating too much fear so far. Okay, different stories. Maybe if we break the yesterday low that has not been broken yet. So yeah, maybe that's going to be a different story now. But so far, I guess the market is looking at this current price action as a little bit of a correction in the context of an uptrend, impulse followed by correction. And in that sense, this is what we are seeing happening. Okay, so again, the only little thread here is the implied volatility being higher in the put side instead of the call side. So we gotta be careful here because of that one reason. Okay. When it comes to reviewing trades that we have running, the trade that really we need to spend a little bit of time there is the Facebook trade that we talked about yesterday. Even though you see Facebook has been continuing his adventure to the upside. How are you, Joanne? Good to see you. But before we get there, so let me look at the midpoint. So when looking at COF, okay, so COF, let's move to here. Okay, so COF is 0.28% higher than yesterday. A green UFO is right there. And again, this is good in the sense that those are forces that are being placed in the marketplace that are likely going to push that stock higher. If that's the case, remember, we are using a butterfly here. Okay, you want to focus on the 4 strikes here, 174, 2 of the 179 short and the 189. And therefore 179 would be the perfect exit point for a target. Okay, even though with all those UFOs there and so on. So again, as price is approaching, you could certainly evaluate if exiting sooner would make sense. That would depend on your trading plan as well. We'll talk about it in future sessions, I am sure. Okay, but so far we have mitigated plenty of the risk of the trade, butterflying it, and now we are just playing that potential move to the upside. With Yelp, I believe that nothing too significant is happening compared to yesterday. It's down by 1.23%, which is not good because it's a bullish trade. So again, we are in the same position where the trade is not doing well, but we have done what we are supposed to do, which is butterflying it to reduce the risk to the maximum and give the trade a second chance. We got plenty of time until February next year. So while it's not looking good in the moment, really there is no concern because the most we can lose is limited. And if there is a push from now until February, which could certainly happen, so we may end up exiting this trade for a profit or a full profit. So that time will tell, and we'll be managing the trade together. Okay, so nothing else to add there when it comes to Yelp. And now when it comes to Facebook, then yes. Okay, so yes, because yesterday we did not tweak this position because it was not making sense. The rules were meant to do it, but the advantage provided by the tweak was basically not an advantage. So we decided not to do it, given the short time to expiration, which is tomorrow. And our approach here yesterday, let me zoom in a bit more, was okay. So if price, which yesterday was trading somewhere up to here, right? So this is a daily time frame. If price was to come back down, which it did all the way to here. So then you would be back in some sort of a profitable territory. Take a look. If I simulate this trade, okay, and we look at exactly, so coming back, so the low of the day, for example, that was 328. So if we look at 328, which is here, okay, that means that earlier in the day when that stock went down right at the open and then started traveling down a little bit, so you got to see your account up by, depending on the bid and ask spread available at that time. Those are obviously a theoretical value, up to $20. Let's say maybe $10 of profit, maybe $5 of profit, maybe up to $20. So at the time, one action could have been to exit or butterfly at the time. That would have provided a better outcome. Now, of course, that's a tough one, because when the market open gapping down and then starts moving down, precisely because there is a gap down, right? So probably you would expect a little bit more of push to the downside and very quickly turn and started rallying in the opposite direction. So I would not be surprised if you didn't have time to do it. Okay, in my case, I was watching it, but I didn't do anything at all because I wanted to do it with you. And next thing you know, that stock just rallied up, so I was not able to act on it. And if we look at the real-time P&L of that stock right now, so it's showing us minus 169.5. This is the real-time P&L of that particular stock at this moment in time. Okay, so now are we in a problematic situation? Okay, well, obviously the trade is not working well. Is this, like, that's it, it's over? Maybe yes, maybe not. Let's take a look at the 55-minute time frame. See what the chart has to offer us, okay? And notice what's happening right here, okay? So price came into the UFOs that we have on the 55-minute time frame. Price started going down. Now there is a little bit of a fight there, okay? And so whatever happened is really going to seem, it looks to me like it's going to determine the final outcome of this trade, okay? Meaning that it's either the red UFO is going to win, or price is just going to continue and those on-fillers will be canceled, and then that's it. Now we're going to get the full loss, which is again part of trading. It's a predetermined loss that we calculated. It was $300 to $400 of risk, and if you took it and you were okay with that, it's not the end of the world. But at the same time, to me, the UFO is still there. Okay, the UFO is still there. That market has been rallying the whole week. Typically, when you look at market statistics, it's a very, very common thing. Again, please don't bias yourself. And if you were to be in a situation like let's say you are short a strangle, where short strangles have unlimited risk, okay, and you were to bias yourself and you were to let a short strangle go against you by whatever amount, that would be really crazy. So you never want to bias yourself. In this case, even if you were to bias yourself, it's not that big as a deal, because it's not a short strangle, it's an iron condor. Iron condors have limited risk. The most we can lose in this trade, I think it was 388. Let me see. Yes, 388. That's the most we can lose. So even if you were totally biased and you were not being realistic in this trade, good news, your risk is limited. So that's a good peace of mind. But again, coming back to something I've seen happen many, many times, and I'm sure many of you, the veterans in the group, I'm sure you have seen it many, many times as well, is that when the market is rallying strong, like Facebook has been rallying during a whole week, Friday is often a day of profit taking, and therefore sell-on field orders may be added, and later today or tomorrow you get to see that stock trading in the purple area. So again, we are really in the same situation we were yesterday. We were in a bit worse situation because yesterday we managed to go as high as this level. Today it went higher. So that's, from that point of view, it's worse than yesterday, but it's the same as yesterday in the sense that we are in that area between the red line and the purple line, which is where the UFOs are. And that means that, being in that area until that UFO is gone, which is not at the moment, you are more likely going to see price come back to the purple zone than not. The question is, we only have 1.5 days for this to happen. will 1 day and a half be enough for this to happen? That's my biggest concern, if you wish. And therefore, you guys need to be managing this trade. I would not leave this trade alone. You could, but given where we are at, which is basically we're in that situation where next thing you know, we can be in a profitable situation. Next thing you know, we can be in a full loss because the expiration is 1 day and a half from now. So given the fact that we're in that situation, I would definitely invite you guys to be on top of this trade. And if later today or tomorrow at the open, something like that, whatever, the stock is back into anywhere into the purple area, just close the trade because that's going to be a profit. Okay. A tough one, tethering a 388 loss. I closed the trade yesterday for a $100 loss. Got you, Christian, got you. Again, the visual impression of the trade is terrible. Okay, the visual impression is terrible. You have this very strong move. Only one UFO is left. We're outside the purple area. It's looking terrible, right? But again, we don't want, unless it's part of your plan and you have a specific rule to get out at that particular level of loss, you don't want to let those human emotions impact you. Objectively, I guess that you are with me on what I just said is objective. There is a UFO, right? There is a UFO, and we were relying on that, on those UFOs since the beginning. Since we put the trade together, we knew maybe they will work, maybe they will won't, they will not, and therefore we knew exactly that the maximum risk of the trade was 388. So in that sense, if you took the trade with all of that in mind, it should feel peaceful. Okay, putting on the side that we are always, proud, or and it triggers many emotions when you're right on a trade and you profit. But putting that on the side, we gotta control those emotions. And objectively speaking, we are in an area where the UFOs are there. They are likely going to push the prices down, and you could very, very easily tomorrow see that stock in the purple area. Okay, so again, we won't be together tomorrow, so I'll let you guys manage this. I need to make a couple of notes to avoid trouble, assignments, exercises, and things like that, so which I need to discuss. But basically, what I would do myself is just be on top of this trade, watch it, set yourself an alert, whatever it is, whatever your style of management is. But the moment that stock goes back to the purple area, you're gonna be in a profit. If it's just the beginning of it, it's gonna be $10, $15 of profit, not too much. But even if it's just dropped here like 325, okay, even at 325, which let's face it, is not that far. Okay, look at the size of this candle. Okay, so only a candle like that it would bring that stock already somewhere here, right? So if you have a little bit of continuation to the downside, just a little bit, you could easily reach like 325, and 325, which is more or less here. This would already pay you $78 per contract. Okay, so and that's today. Tomorrow, if I slide, watch this dotted line here, guys. Okay, notice what's gonna happen tomorrow if I move the slider one to the right. Look at that. That's it. Just because of 1 day, it becomes the top line, right? So in other words, if the move doesn't happen today and it happens tomorrow, and that stock it drops only to, let's say, 328.5, right? Not even 325, right? 328.5, where now you are only making $5, $10, whatever. I'm telling you, tomorrow is gonna be up here. It's gonna be more in the $80, 75, something like that. Just because the time decay, it's accelerating the speed of profitability at the end. Okay, so keep that in mind. And again, no panic, even though of course visually speaking is really not looking good, and that's one of the reasons why we often panic. So that's why I said no panic, because everything that is happening here is within the plan, even though the trade is not looking good and the trade has moved away from the purple box. And of course that's worse than if it stayed inside. Okay, so we may go back and revisit this trade before the end of the session, just in case the market was to push hard to the downside, and we can actually exit today together. So then I'll do it, so I can show you how. But again, I would not put too much effort in looking at this and trying to do too many things. The other thing I wanted to say is, yesterday we tried to reconvert this trade into an iron butterfly, and we decided not to. Today the stock went higher. Okay, so we're in a worse position, and therefore I want to show you what happens in a case like that. So let me edit that iron condor. Let me make sure. Okay, here we go. Yeah, I need to make all of these. Give me a second. Give me a second. Let me redo it. So I'll do a comparison. So if we did this trade yesterday, okay, so basically the profit zone would be somewhere in here, okay, somewhere in here, which is a very narrow range, as we said, okay, and you know everything else you are locking in a loss of 253. That was yesterday, okay. So if I was to, let me duplicate this. I'm going to compare the spread and copy the primary spread. If I was to emulate that I'm doing this today versus yesterday, so we can compare with an orange color. So this bottom four, I'm going to make the midpoint, meaning that I am now butterflying it now. Okay, instead of with the price I got yesterday, which was the fill price, I'm doing it at the midpoint, at the current midpoint, which is now. And if we were to compare, so notice that, you know, now I am in a worse position. Why? Because the stock moved further away, and therefore now notice how my worst case would be 288 instead of 253. Okay. Now, if the stock had gone lower instead of higher, which is I believe I said that yesterday. So if the stock had gone lower, then creating this iron butterfly would produce a much more desirable outcome, where the risk would be limited to a greater degree. So now the orange line, instead of being down here, the orange line would be more higher somewhere here. Okay, and then the triangle, which is very narrow, would be a triangle that would be maybe a bit wider, something like that. Okay, and what happens now? Now your break-even point would be from here to here, instead of from here to here, which was the reason why yesterday I didn't want to take it, because the break-even points were way too close to each other, and therefore it was almost a miracle to end up in a profit in this trade, because basically you needed Facebook to be trading at a very narrow range, you know, on the day of expiration, which is possible but unlikely because it was a very small zone. So I was expecting that. I was, you know, planning to do this conversion from iron condor to iron butterfly today, but for that I need the stock to fall. The stock didn't fall, the stock rally, and therefore today doing it is worse. Okay, so in other words, what's the right action? Okay, at this stage, nothing. That's the right action. Just let that UFO do its work. If it does it, then you're gonna go back into the purple area, and then you're gonna be able to exit this trade for a profit. I would not even bother now on butterflying, because one day to go, you may not even get good liquidity to get filled. So I would just exit the trade, and that's it, and forget about it. Okay, that's what I would do. Again, the one last time, the other possibility, of course, is that UFO may be canceled. It's now removed from the screen, and now Facebook keeps rolling. So then you're gonna take your $388 loss, and that's something that we were okay with at the beginning. Okay. So that's the story about Facebook. Okay, and now the last thing I want to comment on this trade, so you guys understand well everything that is going to happen when it comes to assignment, exercise, or I should say auto exercise, if any, in case we are wrong on the trade. Okay, so let me bring back the strikes. So on Facebook, we are using 285, 290, and 330, 335. Okay, so let me do that. Okay, so somewhere in here, this is more or less 335. Okay, so I'm just gonna click here. So we are long the 335 call, and we are short the 330 call, somewhere in here. Okay, more or less this is 330, something like that. And then below that we are short, I think it was the 290 put, and long the 285 put. Okay, so let me put that here, 290, 285, something like that. Okay, so this is how this Iron Condor is constructed. Let me double check. 335, 338, 390, 290, 285. Correct. I got the strikes right. Okay, so now let's say worst case the stock rallies all the way to the infinite, and now it's Friday expiration and the trade is now over. So what's the outcome? What would happen? Well, if you think about the puts, okay, it's quite obvious. They both expire, and they both expire out of the money, so they are both gone, and there is no assignment and there is no auto exercise because they are both out of the money. Okay, so nothing to talk about here. It's an easy one. Just leave them alone and let them expire and pay no commission, get the whatever premium is left, keep it, and it's done, and the trade is over. Now, what about the calls? Well, if Facebook rallies to the infinite, well, obviously you're gonna be assigned on the 330 call, and you're gonna be auto exercise on the 335 call. So assign on the 330 call will make you short shares at 330. Auto exercise with a 335 call will make you long at 335. Long and short neutralize each other. Since we got $5 of difference, so then you're gonna lose $5. Okay, so you're gonna lose $5 times 100. That's $500 minus the credit collected. So that was a net loss of 388. That's why that's the maximum risk. Okay, so in other words, if the stock goes to the infinite, you will be assigned and auto exercised both. Okay. What else? Well, if that UFO kicks price down and price comes in here below 330, so on expiration, not only the calls would be out of the money, not only the puts would be out of the money, but the calls too. So everything would expire worthless, and therefore you leave it alone and there is nothing to do, and then you made a full profit on the trade. Okay, which this could happen, even though it's not looking beautiful at the moment, but this could indeed happen. Okay, so we'll see that and we'll discuss it next week. But just keep that in mind. If you are below 330, nothing to be concerned. If you are above 335, nothing to be concerned because you will be assigned an auto exercise. The place where you may want to be concerned is what if Facebook is trading somewhere in between 330 and 335. Let's say Facebook is trading at, I don't know, 333.10 on expiration at 4 p.m. New York time when the market closes. Okay, so now what? Well, now you would be assigned on the 330 call, but you would not be auto exercised under 335 because the 335 would be out of the money when the stock is in the middle. Okay, so then what would happen? What would happen is that you would find yourself short shares, and now you're exposed to a gap risk where on Monday the market may gap against you. And now not only you lost on the Condor, but now if you are short shares and the market gaps against you on Monday, so now you have an extra loss, which is the size of the gap, okay, whatever that gap is. Okay, so of course that is adding additional risk, and we never do that. Okay, so make sure that if that stock looks like it's going to be trading between 330 335 before the close on Friday, make sure that you are there in front of the screen and you act on it. And we talked about things that you can do in prior sessions. I'm not going to repeat myself too much. I'm just going to give you one instruction, which is if price is between 330 to 335. So let's say 2 minutes before the close, you just go long 100 shares. That's it at market price. Okay, you go long 100 shares at market price. So now you will own 100 shares of Facebook, and the moment you are assigned 100 shares short, those would flatten your position because you were long plus short equal flat. And then you got nothing into Monday, and then on Monday, even if the market gaps, it's not a problem. Okay, so remember that the risky part is to end up between strikes. So keep that in mind, and that's really what you need to watch for. Right now, the current price, if I freeze the screen, is 334.77. That's in between. So this is a bad location. Okay, you will need to be ready to act if that was to be the case. Okay, so you're gonna have to be watching for this again and make sure you don't forget. Okay, one last thing when it comes to trade management, to make it simple for yourself. So if you recall when we did Did I close the race graph? Yes, I did. So when we did the Facebook trade, okay, the total credit collected was $112. Okay, that was the total credit collected. Okay, so right now at the stage where we are, I guess I made it quite clear, we need to be watching this. Okay, if you want to exit this at the optimal point, you gotta watch it. But let's say you tell me I cannot because I only have time to watch it at that time, or Friday is crazy for me and I cannot watch it. Okay, so now I may end up missing the fact that the market dropped and I was not able to exit the trade for a profit because maybe the market will drop and then later in the day it goes back up again and you missed exiting for a profit. Okay, so what can you do here if you're not going to be able to watch it? And let me log in because finally I forgot to log in TOS, so I'm just logging in now very quickly so I can actually execute that. So you see how it's done. So that way it's a little bit more hands-off. So TOS is loading. You're gonna get to see it on the screen in just a second. Christian, by the way, your platform is okay now, right? Waiting for the update, but with removing that indicator, you're fine, right? Let me know, please. So here's Facebook. Okay, here is Facebook. These are the 4 units that make up for the Iron Condor. Okay, and remember when we did this trade, at least in my case, I got filled at 112. Okay, so what can you do? Well, you can place an order, okay, to buy back the Iron Condor. Wonderful, great to hear, Christian. To buy back the Iron Condor, of course, not at the current price, because then you would collect a loss, which is the current P&L of the trade, but you may want to do it at 112 or less. Okay, 112 or less, because there are commissions involved and you pay commissions to get in. So maybe, I'm just going to keep it simple for myself. I'm just going to have $1 there. Okay, and I'm going to make this good till cancel. So it's valid for today or for tomorrow. Then the order will disappear because the expiration date of the options will expire. So that order will disappear from my account. But this is not like now you're going to make a lot of money at all, unless this happens at the open with a big gap. And next thing you know, because it's a limit order, I get a better feel. But at least that way, if I'm not able to be in front of the screen and that stock has a little bit of a dip and gives me the opportunity to exit for no pain, so that's gonna give me a $12 profit minus commissions, and at least I'm not gonna suffer too much. So I'm just gonna place that order there. And again, this is not how I would prefer to do it. I'm just doing it just in case this is helpful to some of you. Again, I think that could be much more interesting to watch this trade manually, because again, if those UFOs kick in, if tomorrow Friday there is profit taking on Facebook, I should say Meta, and price drops, so intraday you may have a powerful trend and you may want to follow the trend intraday to try to maximize how deep inside the purple area you get. And when you get deep enough so you get a very decent profit, just exit as you see maybe signs of the market coming stronger back up again, and exit for a better profit than $12. But at the same time, this type of execution is super crazy simple, and at least you don't miss it if you cannot be in front of the screen. Because, like, for example, I could have done that yesterday, right? And I would have exited this trade, with an open gap, with a little bit of a dip here. I would have been able to exit this trade for, I'm counting on up to $20, maybe with log, more realistically maybe $10, $15, and that's it. Now, big difference, no problem anymore. Now we got a $169 problem, which may become $388 problem, where you would have no problem if I had placed an order of this sort. So again, I didn't, because my style is more to manage things of this sort, but at the same time, I wanted to share that this is an option which is, I'm sure, helpful to some of you, probably not to everyone at all, but to some maybe yes. Christian, great rundown. Thank you so much for that. Mark, can we put the order into the close, the Iron Condor tomorrow? Yes, absolutely. You may miss on a gap on the open, which is what happened today. So again, if you're not going to have an order in, be there watching so you can decide on what to do, and do it quick and careful with those emotions. Christian, after hearing all that, I am even more convinced I did the right thing. Yes, I get you, but I've seen it so often that an iron condor looks so terrible, and next thing you know, those magic UFOs bring price to the proper location. Next thing you know, that's the beauty of time decay at the end of the cycle. Again, one more time, the angle, okay, the angle here is so huge, going from the current PNL line here to here. That's going to happen in one day only. Notice the amount of theta decay that takes place at this moment in time. It's huge. Okay, it's huge. So yeah, in this sense, you would be surprised on how that UFO just pushes price down just a little bit, not even a lot, and next thing you know, now you have like 50% of the profit or more, just like almost if you were right. So again, we'll know the end of the story next week when we meet again. What matters to me, Christian, if you do that, is that you have a plan that tells you how and when to do that, and where do you draw the line, and why is it, and so on. And if that's the case, perfect. But do not do it out of emotions or out of an impression, because let me ask you this question, and everybody, please, okay? I need everybody to participate on this question. Okay, everybody, just type on the chat box if you ever seen the market, or you've ever been in a trade where it looked like the market was just killing you all the way, and next thing you know, you reach your final target. I'm not saying this will happen very, very often, but it happens. And in this case, you don't need to reach a final target. You just need a little bit of a drop to reach the purple area. Okay, so there is no reason to panic. That's my whole point. I'm not trying to convince anyone to do anything, because in the end, it's all about your trading plan. I'm just here to guide you on how to use the tools, and of course, lead you into understanding how trading and markets work, and trading concepts and techniques, and the pros and the cons of rules and everything. But in the end, we are all different. But again, let's not be led by impressions, okay? Let's be led by rules in our plan. Never seen it, Christian? Got you. It happens. Believe me, it does. I'll buy you. I'll buy you a beer if you're right, Jose. Got it. The only problem is I don't drink, Christian. So, but it'd be lovely to get together for a coffee. That's for sure. Good, wonderful. Thank you, guys. Okay, look, we need to find some trades out there, but I needed to comment on all of these, especially because we have the risk of assignment, the risk of auto exercise. Again, I'm using the word risk because that's how it's called. It doesn't need to be a risk if you know what it is and you are managing it. Okay. Cool. So now let's move into researching opportunities. Okay. Now the VIX is trading at 20, and it's not like 20 is a lot, but 20 is more than what we have seen in certain other cases. And because the S&P is in an up climate, and because the S&P is in the beginning of the up climate, meaning that normally what would happen is that climate expands. Well, if the market was to rally, then typically the VIX would drop even more. So I would like to take advantage of the VIX being at 20. And also the reason why is because I don't want to be aggressively directional to the long side. And by the way, I'm reading you, Christian. Thanks for that. And by the way, why is it? You guys tell me, why is it that while the climate is blue, okay, why is it that I'm not too keen on being aggressively positioning myself to the long side? Why is it that I prefer, apart from the fact that VIX is 20 and we can sell some premium, why is it that I'm not keen on positioning myself aggressively long, trying to profit from directional moves instead of non-directional? Why is that? Anyone? You guys tell me. Let's see if you can read my mind. So in the meantime, I'll set up the matrix with high implied volatility. I will set up the matrix with no conditions for the stock filters with my scan list. Okay. We got no symbols. Strength levels, neutral and neutral. earnings less than 15 is fine, and auto climate is disabled. Okay, so by filtering for neutral trades with high implied volatility, of course, with the VIX going down, we don't have results if we filter for range greater than 80. Okay, now we have other ways on how to filter, which is implied volatility mean greater than 2 standard deviations of historic volatility, and that way we don't get anything either. So you can tell the volatility is dropping in the market. And the last one is the greatest increase of implied volatility mean in the last 5 days, greatest percentage increase. Let's see if we get some results by doing it this way. And if not, we don't. And if not, I was going to say we're going to have to tweak something, which I'm going to do in a moment. Let me take a look at the chat box. Yeah. So no one responded to my question actually. If you have a margin account, can you do the buy shares and use the margin to cover the cost of the buying the shares in that case? If you have a margin account, can you do buy shares and use the margin to cover the cost of buying the shares in that case? I don't get you, Mark. If you have a margin account and you buy shares, then you own the shares on margin. And based on the regulation, that means that you need to pay half of the price of the shares because you got 2-to-1 leverage on margin accounts for stocks. I'm not sure if this answers your question. Okay, well, the reason why I don't want to get aggressively bullish yet is because remember, on the S&P, right? When we looked at the S&P, the implied volatility of the puts, it's greater than the implied volatility of the calls, meaning that while we are in an up climate, we are a bit more in let's call it corrective mode. And I would say it's probably more likely we're probably going to see stocks to fall a bit, maybe for a day or two or something like that, before the climate resumes and continue moving to the upside a bit more aggressively. Now we are having those, very indecisive candles on the S&P, and the implied volatility of put greater. It's a little bit of a concern. Okay, so that's why I prefer to play the non-directional now until the implied volatility of the call surpasses the implied volatility of the puts, and then I'm going to be more convinced, if you wish, that betting to the upside is safer. Right now, it's not crazy. The climate is up, but it's not as ideal as if the implied volatility of the calls was above the implied volatility of the puts. Okay, so hopefully this clarifies. Joe, thin blue auto climate dots, implied volatility of the puts greater than the calls. Yes. Now the thin implied volatility dots is on Facebook. Okay, on the S&P it was confirmed. Okay, so that's not a problem. But indeed, you got it right with the implied volatility. Same to you, Mario, and Mark. Yes, that's answering the question. Very good. Perfect. Okay, good. So hey, I've been doing a search looking for non-directional trades with high implied volatility using the 3 techniques that we use, which is range greater than 80, implied above historic 2 standard deviations, and greatest percent increase of implied volatility in the last 5 days. And with my current settings, I've got nothing. Okay, so what else can I play with? Okay, what else can I play with? Well, I'm going to go back to 80. Okay, implied volatility greater than 80. And now, because here, I cannot change anything here. Okay, so the meaning that stocks, scan, earnings, all of these, I cannot change it. The one thing I can change is when it comes to the strength, now I'm being demanding, looking for neutral strength all the way from a daily time frame to all the way to a weekly time frame. So what if instead of daily to weekly, I look at daily to 3 days? Nothing. What if instead of daily to 3 days, I look at 2 day to 3 day? Nothing. What if now I switch to mean minus historic above 2 standard deviations? Nothing. What if I do 1 day to 3 day? Nothing. And finally, the one that typically returns more results, which is top percent increase. Let's see if we got results. We got 1 GLW with daily and 3 days. And if I was to do 2 day, 3 day. So GLW and GLW, okay? So not too much to choose from today. We can tell that the implied volatility in the market is really, really dropping, okay? So let's move and see if we can find a valid setup, and at least we approve the trade, okay? So looking at the probability cone first, okay? Let me delete, remove lines for the current symbol. So earnings are happening all the way here on January 26th. So what I'm going to do is I'm going to look at the skew for GLW. Wait a minute, because funnily enough, I forgot what I said. I said January 26th. So January 26 means that we can go up to January 21, but not January 28. And therefore, I'm just going to enable all those various expiration dates, calls and puts, and see what I can learn from these particular graphs, okay? Well, as you can see, by far, okay, the December 10, which is the one which is gray color, has much more implied volatility built in. That is quite normal, okay? That is quite normal. Unfortunately, you often have another one kind of like follows here, something like that. But now it seems that most of the implied volatilities, they are all packed. They are all around very, very, very close, lining up around that 30 mark, something like that. There is not too much to choose from. The only thing we can do is just to try. We're going to use the spread select. In this case, we're going to use all the expiration dates, okay, all the way to January 21st, to see which one works, because while implied volatility seems to be very similar for most of the strikes, we do see that from time to time we have some price anomalies, okay, those, peaks or troughs. We have some price anomalies, and this equals an arbitrage or semi-arbitrage opportunity available, and this is what we're going to play when building the Iron Condor on GLW, because when it comes to catching great level of implied volatility, well, of course, my preference would be December 10, because it's the one with the greatest implied volatility. But my friends, that's tomorrow, isn't it? So we are not going to do that one. And again, when you look at all the other ones, notice how close they are from each other. Okay, so we are going to be basically planning on our own Condor and exploring what happens with all the various expiration dates, because that's what it is. Okay. Let me see. Christian, that trumps the volume map. I think you are referring to the implied volatility of the puts above the implied volatility of the calls. It is not trumping the volume map. It is complementing the conclusion you get when you read it. Okay. So, for example, at this moment in time, with GLW, you can see how you have more calls traded than puts. Okay, we have more calls traded than puts. But the implied volatility of the puts, it's 41 versus 31, which is significantly higher, it's 10%. So what does that tell you? That while more calls are traded than puts, they seem to be sold. Okay, they seem to be sold. Okay, yeah, and I'm applying this to GLW, but the same would happen to the S&P. Okay. Yes, Ahmed, I understand GLW is not liquid at all, okay? And that may be a problem we face and we may need to abort, okay? But that's the only one I got in the list, okay? And that's what the market is giving me today. So I'm going to take it gladly and see what I can do with it. And if it doesn't meet the rules, then we'll cancel it, okay? But yeah, for sure. You can even see here how there's nothing traded there, just one contract, no contracts here. So yeah, it's not looking amazing, okay? But remember, we can go all the way to January 21st. So we may find some expiration date that is okay. Okay, so let's not give up. Okay, and let's give it a try. Let's give GLW a chance, and we'll see what can be done. Okay, so I'm just gonna select the right type of strategy, which is gonna be a short Iron Condor. With that short Iron Condor, we're gonna select all expiration dates until January 21st. Okay, we're gonna skip December 10 because that's tomorrow. And we're going to be looking at up and down. Now, the minimum range, it seems that I'm going to get is 0.5. But again, we know already that stock is not going to be too liquid. So if we look at 0.5 strikes, it's going to be even less liquid. So I'm going to start with one minimum. But also that stock is a $37 stock. So it's not like it's super pricey. So I'm going to stop there from 1 to 2. I'm not going to go for like 10 strikes or something like that, because you would be taking a $1,000 risk on a $37 stock. That makes no sense. So I'm going to do $1, $2. I'm going to enable my filters and select the filter for the iron condors by loading its template. Okay. And with that all set, we're going to now produce 99. And we're going to be able now to sort them. And we have 4 that pass using December 31, January 7, January 14. So let's see if that works for us. We'll start with December 31st. So when looking at December 31st, which is here, okay, so December 31st has the more extreme line is the red color one. So we are talking about a range between 41.8 and 33.8. So 41 to 33. And the range here is 40. Okay, so that is not good enough. Okay, not good enough. Therefore, we're going to get rid of anything prior to December 31st from an expiration point of view. Okay, and we're going to explore our 3 last choices, January 7, 14, and 21st, by building new spreads and sorting again. We have 3 more than pass. 2 are January 7. So let's take a look at January 7 first, which is right here. So January 7 is pointing at 42.4 and 33.2. Okay, so 42, 42, and here is 40, and here is 40. So that's not good. Okay, not enough premium to produce what we need. So we're gonna do the same. We are going to get rid of January 7, and we are now left with January 14 and January 21st. Here we go. We have 1 for January 14 with a range of 41.74. That's not going to work because already January 7 was 42. So January 14 is going to be more than 42, and this is 41, the break-even point. So it's not going to work. And therefore, it's looking like I got 1 choice left, which is January 21st. So let's see if that one will pass in the end. And it doesn't. Okay, it doesn't. Yeah, really no volume. Yeah. So yeah. So bad news there with this type of trade. I wanted to do some sort of a non-directional trade, and I could not find a setup at this moment in time. Maybe later, an hour later, yes, but not at this moment in time. A setup that meets our rules. Okay, so then we're gonna pass. So what else can we do? Okay, well, let's use common sense. The climate is blue, but I'm concerned. Okay, so if the climate is blue, but I'm concerned, I'm okay to be exposed to the markets to be bullish with positive deltas, but I want to be exposed to those positive deltas in a way where I have a wiggle room that allows me to be wrong and not to suffer too much. If the climate was totally confirmed, the implied volatility of the calls was above the implied volatility of the puts, if everything was perfectly telling me time to go long big time, while I would still have hedges in the portfolio, diversification and so on, but I would be okay to enter from a timing point of view, enter now with the full delta exposure, no problem. Having said that, it's not the case. I do have a concern when it comes to the market may have to drop more before it continues. And therefore, I want to give myself a little bit of a wiggle room. How can we do that? Well, the way to do that, okay, and this is very much related to the lecture that we had yesterday with Josip, isn't it? So the way we're going to do that is we could buy a call, and in order to buy that call, as we have done many other times before, we can sell 2 puts and buy 2 puts below price to produce a credit that pays for that call. Okay, we've done that before. Josip yesterday was doing it without the two, okay, which is a different way on how to approach it with pros and cons, like everything we do in trading. This is the approach I had before in the session. This is not new to you, isn't it, guys? And when I do that, the way I like to find those opportunities is by utilizing the speed bump filtering tool built in the platform. So I would come in reversal signals, look for speed bumps of support. I'm not going to be looking for supports of resistance because we're in an up climate. Even though implied volatility of the puts is above implied volatility of the calls, we are in an up climate. Okay, so we're going to be looking at support, and with that support there, okay, ideally, okay, that's going to reduce a lot my opportunities. So I may remove that filter later, but also I would want to see a top positive CIV spread. That would be great. One second, guys. Okay, so having a top positive CIV spread means that bullishness is entering that stock, and being inside the speed bump means that we are in a place where typically you're going to have a strong turning point. And then, of course, now we're going to rely on UFOs, and then with a put call combination, we're going to do something interesting. What else do I need here when I filter? Well, I would like the stocks I pick to be strong. Okay, so long-term strong. I would want my scan list to be there. I would want no strength filtering here. I would want my earnings to be further out, like 30 days. And I would want the auto climate, ideally, you would want the auto climate to be not only confirmed down, but to be late, meaning that stock has been dropping aggressively down and is very, very tired when it comes to falling. Okay, so again, that's very demanding. And here's the result: none. Okay, so maybe I'm going to be a bit less demanding with hopeful, and I get something. No, maybe I'm going to be a bit less demanding with no positive spread, and I get something. No. What if I uncheck auto climate? Let me see if we got something, and then we can evaluate. We got 3 in the whole market. Okay, so ODP, Snap, and Twilio. Okay, so let's click on those symbols. And again, I don't need the auto climate and things like that in this case, because thanks to the option strategy, by selling puts below price and buying calls above the price, I am gaining the positive delta I want, where if the stock moves, I'm going to profit. But if the stock was to move against me, I'm not really being hurt until I reach those puts, which are lower in price. And if the climate is not late now, it's going to be late later if the market keeps falling. Is that making sense? So it is not critical. It's a good tool to be even pickier if you had a long list with many results. But if I have few, I'm totally happy on checking it for this particular type of scanner. Okay, so now if I look at those 3, do I have any of those that also produce the positive CIV spread? Let's see, too good to be true. No, yeah, we have 2. So ODP and Twilio. Okay, so I'm going to take a look at Twilio and see what's happening. So Twilio, it's moving higher. Actually, it's in a blue climate, even though it's not confirmed. Implied volatility of the puts is slightly above the calls. Okay, that is obviously not ideal, but I'm not too surprised, not too concerned either, because this is the same that is happening to the S&P. Okay, so if the S&P changes, this will change. And since I'm going to give myself space below, so maybe okay. When I look at that stock and I project the speed bumps, okay, from prior pivot points. So actually I have it here, right here. We are inside the speed bump. That's why it's there. Okay, so we are inside that speed bump, and that's why the stock was returned. Okay, so this is how Twilio look like. Now, before I look at the options, I want to look at the technical. So what about ODP, which is our other choice? So ODP, to be honest, I kind of like better this setup. We have the implied volatility of the calls greater. And if we look at, so 69% on the daily, those UFOs look like very powerful. The only issue is that they are quite far. Okay, and the options are not going to be too liquid here, so I'm not sure if we're going to be able to do it. But in any case, take a look at what I would think. It's a very nice plan. Okay, let me activate pivots. So if I add my speed bumps to the prior pivot, okay, so the price of the stock is now reacting to this pivot. Okay, so that's where we're at. So what I would love to do is I'd love to sell puts here, and in exchange for those puts, buy calls somewhere here. So if the stock rallies, I profit. That's what I would like to do. And by the way, just because the other day you attended the webinar with Josip, because I'm trying to add myself extra wiggle room to afford for the price of the stock to initially start moving against me, like happened with COF, and then started moving my way, right? And not to suffer too much on that. So I'm selling puts far out of the money. Therefore, I get paid very little. Hence, I sell two. What Josip was doing is that he was acting close to at the money. And because it's close to at the money, he gets paid more, so he can do it with one. But then it's a bit more exposed when it comes to the directional move. You get more delta. In my case, I'm going to have less delta. Okay, so I'm being more cautious. And the reason why I'm being more cautious is in line with what I told you about the S&P, which is the climate is blue, but the put implied volatility, it's winning against the call implied volatility. Okay, so just for you to think about it, okay, as you are digesting what we do in the session as well as what you have been learning in the webinar yesterday. So so let's go for it. Okay, let's see if we can do a trade here. Again, between us, I don't think it's gonna work because the stock is too cheap with $30. But maybe yes, you never know. So I'm loading my option chain here to see what's gonna be possible. Now, if I'm gonna take this trade here, so where do we think the stock is gonna go? Okay, so next pivot point is right here. There is no red UFO. So, reaching this level of 48 to 49, it's doable. That's a $10 move on a $38 stock. That's impressive, my friends, okay? But again, the space on the chart is there, even though I'm only looking at one time frame. So if I look at the 2-day time frame, careful, we have a UFO there at 46. And if I look at the daily, we have more UFOs as well with 69% probability. Okay, so again, 4382 I think would be a much more reasonable target. Where is that located at? 4382 is somewhere here. Okay, so 4382 is more or less here, and that would be the target that I would feel it's more adequate. Okay, so I'm just gonna draw a line here at 43 something right there. Okay, this is what the target would be for this trade. So if I was to estimate the time to target, so we are looking at January 17 to reach such target. So I need to use options which are at least January 17. Okay, so again, let's come back to the option chain. Okay, look at January 17 is going to be 21. I'm going to skip the weekly because of potential lack of liquidity, and I'm going to look at February and May to see what the liquidity suggests. Let me go ahead and focus on that 30 strike, that 31 strike, which is the price of that UFO, 3098. So if I look at the 31 strike and I'm looking at the puts, what do I get? I selected 30 instead of 31, sorry for that. Okay, so what do I get? Nothing. I get nothing. I get 14 cents, 37 cents. Funnily enough, with May expiration, I get more premium, and the liquidity is not that bad. Like 12 cents in a $1 option is not that bad. Let's explore. Okay, let's explore and see what happens. So if I sell that option, okay, and then I buy the one below. Okay, let's edit this. So if I sell the 31 put that expires in May, and I buy the 30 put that expires in May, so that creates a credit of 17 cents. Okay, 17 cents. Oh, yeah, it's gonna be bad. It's way too little. So it's not gonna work. Again, the problem I'm having here is the underlying stock is too cheap, and therefore I'm not getting enough premium to justify anything here. So if I look higher, yeah, it's just not gonna work. Yeah, it's just gonna be a waste of time. Look, I'm just gonna do it on the screen so you see it. Okay, again, hopefully from a process point of view it was useful. The trade will not be valid, and we're gonna conclude the session in a moment. So that's it. But anyway, let me show you the end of the story. So this is 117. If you do it twice, okay, so sell the 31 by the 30. If you do it twice, you get 34. Okay, let's say you want to get a little bit more risk, and instead of 30, you do 25. Yeah, but that makes no sense. There is no more strikes there. It doesn't make sense because from 25 to 31 is $6 of risk times 2. That's $1,200 of risk for a $30 stock. I don't want to do that. Okay, I'm just not doing it. Using 30 and 31, yes, because that is $100 of risk times 2. That's $200 of risk. So then you are absolutely right. Thank you, Mark. Thank you. So let's restart here. January 21st and July. So those are going to be the two that we're going to explore. So let's do the same I was doing. So looking at 31, there is no 31. We got 32 and we got 30. So let's take a look at those two. We got 55, 40. This is January. Actually, there is more premium there than with GLW. And with the other one, yeah, absolutely zero volume. Nothing has been traded today. I'm really not happy about the July. With this one, little bit of volume. Not amazing, but the spreads are contained between 50 to 30. Not so contained for the 32. Yeah, it's difficult to do, guys. Difficult to do. 180 to 50 cents, that's gonna kill us, and we need that strike. If we do the next strike, it's not gonna work because the next strike we're gonna sell it at 30 and buy at 55, so it's gonna be a debit instead of a credit. So that wouldn't work. 32 is the one, and that asking price of 180 versus the bid price of 50, that is killing us. So yeah, my friends, no trade. That's it. That's the end of the story in the end, which was going to be difficult because of the cheap price of the stock. Because of course, the cheaper the price of the stock, the less you get paid for the options, and if you get paid a little credit, so then it's difficult to buy a call which is near. And if the call is near and the puts are far, if the puts are far and the call is far as well, if everything is far, then the amount of delta is very low, which is almost not a directional trade. Okay, and you don't have a debit, you don't have a credit. If you do an Iron Condor, it's not directional, but you have a credit. But here you will not have a credit because you plan to use the credit to buy for the call. Okay, to pay for the call. So anyway, not a successful setup, so we will leave it alone. Hopefully today's session was okay. I wanted to take a quick last look at Facebook to see if Facebook came back a little bit. No, it looks like it's doing the same. Okay, so just a bit more patience there with Facebook. Into later today and tomorrow, watch it. If you've done what I've done, the order is in. You can see how that UFO is doing its work. Okay, so just let it do its thing. Okay, let's not be victims of trading emotions, which is obviously something that can happen easily to any one of us because we are human. But we know it's a big enemy. Okay, so let it do its thing. My friends, I will see you on Sunday in the top session. Looking forward to that. We didn't have a top session last week. So looking forward to catching up. I'm talking about sessions that did not happen. In this case, I will talk about a session that won't happen, which is next Wednesday. I will not be able to conduct the session as normal. So if there is any change in the schedule, I will let you know. We'll send an email. Watch tradewithufos.com/live where you have the calendar in the website because the updates will be there. But what's most likely going to happen is that we will meet on Thursday, not on Wednesday. Okay, my friends, pleasure. See you on the next one. Keep up the good work. And if you have any question or anything, guys, just send us a message, and we'll help you guys on whatever you guys need. Take care. See you soon. Bye bye, everyone.